this year, we spoke with an outfit called Hims Hers Health. And if you somehow missed the ubiquitous ads, this is a digital health and wellness platform focused on sexual health, skin care, mental health, and weight loss. Basically, they set up a website where you can talk to doctors via text in order to get treatment for, let's say, more sensitive health issues. They sell generic versions of treatments for ED and for male pattern baldness. Somehow the rest of the world still hasn't recognized that bald is beautiful. Weight loss drugs from what are known as compounding pharmacies. That's the other thing they have. These are GLP kind of knockoffs. In short, they treat anything embarrassing where it's easier to talk to a computer than a doctor. All right, that's the basic idea behind Hims and Hers. Now, when we first spoke with CEO Andrew Dudum in late February, the stock was just red hot, and it gained more than 30% in a single day after the company reported a strong quarter and issued a very bullish full-year forecast. That breakout into the teens in late February was important because Hims and Hers Health came public via a SPAC merge that closed in early 2021. And this was the moment it finally broke out above the baseline SPAC level of $10. Even late last year, the stock was stuck in the mid-single digits. Just another post-SPAC play that wasn't working, that hurt people. You know what I mean. But ever since that blowout quarter in February, well, the market has started taking this story very seriously. Now, I bring all this up because after some choppy trading in March and April, Hims and Hers started rallying like crazy. From early May through mid-June, the stock climbed from around $11 to a high of $25 and change. I don't know if you saw it. It's almost like levitating every day for pulling back to $20 and change today. Still, even back down here at $20, the stock's up 127% year to date and up just another 50% since our late February interview. So it's long past time to play catch-up and explain what the heck is going on here. First, when Hims and Hers reported in February, they not only reported strong growth and a surprise profit, management also gave incredibly bullish guidance. CEO Andrew Dudum explained on this show that the whole business model is about breaking down barriers to access for these drugs, which brings a ton of new people into the market. The stock took off again after Hims and Hers reported another phenomenal quarter in early May, a monster top and bottom line beat, up 46%, subscribers up 41%, earnings before interest, taxes, depreciation, and amortization growing by 434%. Company earned 5 cents per share, analysts were only looking for a penny. Now that's a smoke show. Management said it could put up these numbers because they were offering a wider breadth of product categories on the platform, including weight loss drugs. In response to the quarter, the stock immediately jumped 6%. But that wasn't even the biggest positive catalyst of the past couple of months. On May 20th, 2 weeks after the first quarter report, Hims and Hers announced that it would start selling GLP-1 injections. Remember, people are desperate for these revolutionary weight loss drugs. That said, the company isn't actually selling the patent-protected stuff from Eli Lilly and Novo Nordisk. Instead, they're selling what's called compounded medications, which use the same active ingredients in a copycat formula of the drugs. Normally, the regulators won't let you violate someone else's intellectual property like that. Those compounded drugs are only allowed in situations where the supply of the real drugs are limited, which is exactly what we have with GLP-1s. Crucially, this product that Hims and Hers is selling isn't actually FDA approved, but the upshot is they're selling the active ingredient for a much lower price than you can get anywhere else. It starts at $109 per month, which is a fraction of what the real Ozempic or Zepbound costs. When Hims and Hers announced the new access to GLP-1 injections, the stock rightly jumped nearly 28% in a single session. Even as the news wasn't exactly a surprise. I mean, people have been speculating about this story for months. How big of a business could this be for Hims and Hers? Analysts at the healthcare-focused research firm Leerink Partners took a stab at this question last month, and here's how they put it, quote, "We have built our first cut at a sensitivity analysis to understand just how big the opportunity could be with with estimates that get quite large quite fast," end quote. Quite large quite fast. I like that. Specifically, Leerink projected that these compounded GLP-1 drugs could increase Hims and Hers EBIT, that's the earnings before interest, taxes, interest expense and taxes, by anywhere from 7% using conservative assumptions to 150% using more aggressive estimates. That's a lot of leeway, I know, but it sounds pretty positive to me. No wonder the stock more than doubled from early May to mid-June. Hims and Hers finally took a breather once the stock reached its mid-20s, but then something else happened. On June 27th, an outfit called Hunter Brook Media, which is a new venture that's part hedge fund, part media company, and similar in nature to an activist short seller, published a negative report on the company's move into these compounded GLP-1 shots. Their thesis. First, Hunter Book points out that Hims and Hers' ability to sell these compounded GLP-1 drugs could end at any time, and that is true. Like I said before, you can't just violate another drug company's patents. It's only allowed as a temporary measure when there's a shortage of something important. We know that Novo and Lilly are working really hard to bring more production online. And if they're able to get more supply, then these compounded drugs, they'll just stop. They'll be shut down. But you know what? Demand for these GLP-1s is so strong that I think it'll be some time. Might be a while before there's enough official supply to sate the demand. I'd add that Hims and Hers has said that they'd like to work with Lilly and Novo Nordisk to get their users access to the real thing. That's nice to hear, but it comes with additional questions, including how much of a margin did they take from that change. The lower price point of the compounded GLP-1 is a huge part of the appeal here. So switching to the real thing, let's just say, certainly wouldn't be all that lucrative. The other relevant negative from the Hunter Book report on Hims and Hers, the authors argue that the company's getting its compounded GLP-1s from a single supplier, Belcher Pharmaceuticals, which has, in their words, quote, previously unreported ties to fraud and bankruptcy, end quote. Now, that was news to us. It was certainly not a great look for Hims and Hers, though. I'm not sure how much it impacts the estimates. The Hunter Book report also said basically that people can get the compounded GLP-1s through Hims and Hers without speaking with a doctor, which opens the company up to litigation risks, especially as these compounded GLP-1s are not FDA approved. Okay, at least they're putting it out there. Now, the stock had already pulled back from 25 to 21 before this Hunter Book short report came out, but then it tumbled to 20 after it came out and it traded sideways ever since. So what do we do with the stock here? Okay, frankly, I'm actually torn about this one. While it makes sense that the stock's roared on the compounded GLP-1 news, I don't love that it's now trading on what's essentially a temporary business. However, I liked Hims and Hers before this whole GLP-1 dalliance sent into the stratosphere. Those great first quarter numbers didn't have any benefit from knockoff GLP-1s, and I bet the business stays strong. So the bottom line here, I'd never recommend paying up for Hims after that big run at 25. But now that it's pulled back to 20, I think you can justify building a position here, especially if you buy it gradually on the way down and don't place all your hopes on the temporary GLP-1 business, even as it is incredibly strong. Let's go to Mike in Illinois, please, Mike.
Hey, Jim, how are you?
I am good, Mike. How about you?
I'm great. I want to thank you for all you've done for me and for all the numbers. You guys are exceptional. You and Jeff have helped me out a ton since I joined. I'm up over 40% in my portfolio in the last year, and I'd say you were a good reason, one of the major reasons that happened.
Oh, thank you. Jeff and I were talking back and forth today. We got a meeting coming up next week. We're going to try to review what we talked about at our annual meeting, give like a 6-month look-see. But thank you. You encourage us, makes us work harder. I really appreciate it. How can I help you today?
Well, one of my dogs is Abbott. It's actually my biggest dog. I'm down about 9% since I bought it. I've added to it a couple times. I know it went up today. I know you said that this loss is going to come through and not be nearly as damaging to the stock, and hopefully it'll bottom at that point once that comes out. But I'm wondering what you want me to do, buy, sell, or hold.
Let's take this. Let's take it. You know me. I take it head on. They report on the 18th. I don't know. I think the company's doing incredibly well. The lawsuit is in Missouri. It's the worst venue. That's why I prepped everybody to think that they could lose it, even though I don't think they should, which is why we're holding off buying any more until it breaks under 100, or else we're happy with our position. That's our plan. And I thank you for those incredibly kind words, and I'm sure Jeff will too. Let's go to Richard in California. Richard.
Hi, Jim.
Richard, what's up?
You always say pick best in breed. Well, this company is only in breed. This AI tech service company is exploding in all financial metrics. They just entered a very large market in Texas. Growth will be rapid. All their core markets are growing like a weed. The White House has them in the Moonshot program to help end cancer, and they're at the top of their list. Their breast, prostate, lung cancer AI is already up and running with serious revenue and growth. They're developing generative AI to run all basic company needs, billing, appointments, workflow, etc. It will be a game changer for profits by year end. Most importantly, this product will be for sale. It will revolutionize healthcare services, hospitals, imaging centers, diagnostic centers. This company's growth over the next 12 months and beyond will be mind-boggling. RadNet.
Oh, Dr. Berger. Yeah, I mean, this is one of the reasons why, candidly, I thought that GE Healthcare would be doing better because they're a big supplier to RadNet. RadNet is just doing incredibly well. You're definitely right. It's a very interesting story, and every time we've had them on, it's been terrific, and I think it's going to stay terrific, and it's a really good call by you. All right, listen, as long as you're not centering your investment thesis for HIMS around its GLP-1 business, then I think you can start building a position at these levels. Much more mad money at Weyerhaeuser has been going down. But is it too late to yell timber? I'm checking in on where the lumber producer stands after its recent severe underperformance. Then, the only thing more torrid than the love for tech hardware stocks is the absolute hatred for enterprise software. I'm giving you my take on the love-hate relationship, trying to make some sense of it. And all your calls rapid fire in tonight's edition of the Lightning Round, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.